Gather around, my friends. Let me share a story about drawing support and resistance levels correctly. Have you ever looked at a chart and thought, oh, what the hell is even that? Well, today, I want to change that for you. Support and resistance, these key levels, are among the most essential concepts you absolutely must master when trading. Yet, tragically, 99% of traders are still getting it wrong. Why are these levels so critical, you ask? Because if you can find them correctly, they will unlock high win rate trade opportunities. Let me paint a picture with an example. Imagine a resistance level right here. The price climbed up to this specific point, hit an invisible ceiling, and then sharply reversed downwards. Now, logic and history tell us that the next time the price approaches this exact level, there is an incredibly high probability that it will reverse downwards once again. This is where you could have confidently entered a trade. However, a very common and fatal mistake that many traders make is turning their charts into a chaotic mess. They draw far too many lines, clustering them until the screen looks like a spider web. What the hell are you doing, bro? You must stop this immediately. How can you possibly trade with 10,000 lines scribbled on your chart? It only serves to confuse you further. The entire purpose of drawing key levels is to simplify our analysis, to make the market's movements clearer and less confusing. The reason so many of you are still making these frustrating mistakes is simply that you are not following the secret rules of support and resistance. Let us delve into them. The secret rules of support and resistance. The very first rule is to look for multiple rejections. In one of our examples, you can clearly see that the price dropped down to a specific level 3 separate times before bouncing back up. This repeated action shows us multiple rejections, giving us the perfect foundation to draw a solid support level right there. Conversely, every single time the price surged up to a certain high point, it was repeatedly rejected and forced to reverse. This allows us to confidently draw a resistance level right there. Now you might be wondering, what if the chart looks completely different and there are no multiple rejections yet? I am so glad you asked, because that brings us gracefully to the next rule. The price needs to move significantly away from the swing low or swing high. In this scenario, you might notice that the price hasn't formed multiple rejections yet. But observe how it reacts. When it forms a swing high and moves away from it and then reverses to head back down, it doesn't just inch away. It moves significantly. When you see this powerful movement, you can confidently draw a resistance level right there. Let's look at another scenario. Imagine the price has been trapped in a relentless downtrend. It finally hits a specific area, reverses sharply, and shoots back up with significant force. In this case, you can confidently draw a support level right at that swing low. The next rule to remember is that a level can act as both support and resistance. A floor can become a ceiling, and a ceiling can become a floor. Imagine drawing a support level at a point where the price reversed 3 times. Whenever the price dips back to this area, it always shoots back up. It's a very strong support level. But then, watch what happens when the price finally breaks through this support. It often climbs back up to retest this very same level, and suddenly, your old support level is acting as your new resistance level. You will see the price struggling, unable to break past this newly formed resistance. Finally, the levels you draw must be relevant to the current price. When you are marking a key level, you absolutely do not want to mark one that is miles away from where the price is actively trading right now. Levels that are too far away are simply irrelevant. Drawing them is pointless because we only care about the levels that matter right now. Remember, too many lines will just confuse us. So, focus on the immediate battleground. Draw a support level where the price currently reverses and heads back up, and a resistance level where it is currently being pushed down. These are the only key levels that matter in the present moment. Applying the rules to the charts. Now that you understand these 4 secret rules, let's bring them to life on the charts. Imagine looking at a chart and drawing a resistance level right here. Why? Because whenever the price climbs back up to this point, it always reverses, showing us clear multiple rejections. It is a very strong resistance level, and crucially, it is near our current price, not lost in the history of the chart. Next, observe when the price moves away significantly from a swing high. You can draw another support level here because whenever the price drops down to this area, it always reverses, proving it is a strong support level with multiple rejections. Then comes the moment of truth. The price finally breaks through our support level. Watch closely as it climbs back up to retest this old support, which now fiercely acts as a new resistance level. And please, my friends, remember this vital detail. This entire area is your support or resistance zone. They are not just single thin lines. This entire zone is the battleground. That is why when the price comes back to retest, it interacts with an area, not just a line, before rejecting it. Let's look at another chart. You can easily spot multiple rejections right here. Whenever the price drops, it ends up reversing and heading back up. Clearly, this is a support area, and above it, a resistance area, perfectly satisfying the rules we just discussed. But would you mark a level way down here? Absolutely not, because that is not where the price currently is. It is irrelevant, ancient history, like dinosaur bones. We do not need to care about levels from 10 years ago, a year ago, or even a few months ago. Focus intensely on where the price is right now. Draw the most recent key levels. The only time I would draw a far-off support level is if the price breaks through the current ones and starts heading down towards it. But if the price is consolidating within the current area, keep those distant levels off your chart. How to actually trade these levels. So now you know how to identify these levels, but how do you actually trade them? I am thrilled you asked. Imagine you have marked a strong resistance area because the price always gets rejected there. The first thing you must do when the price reaches this key level is observe. Is it going to break past, or is it going to reverse? In one of my favorite examples, the price gives us an evening star candlestick pattern at the resistance level. This is a classic reversal pattern, screaming that there are many sellers in the market, the uptrend is over, and the price is going to head back down. There are hundreds of reversal patterns, but the evening star is a personal favorite because it is so easy to spot. Seeing this pattern at a key resistance level is our first sign of a reversal. But wait, we do not enter the trade just yet. We never enter immediately upon seeing the pattern. We must wait for multiple confluences. We need further confirmation that the price is genuinely going to reverse. The next confirmation I look for is a moving average crossover. Previously, the price might have been riding above the moving average, but right at this critical moment, the moving average crosses over and is now positioned above the candlesticks. This is our second powerful confirmation that the price is reversing. When I see the moving average crossover, the evening star pattern, and the price at a key resistance level, I have the three confirmations I need. I will boldly enter a sell position right there. I will place my stop loss safely above the resistance level. And remember, never place your stop loss too tight. There is always a chance the price will pop back up to retest the area before falling. Give your trade some breathing room. As for taking profits, I always place my target at the next key level. If you look to the left of the chart, you might find an old resistance level that is now likely to act as a new support. That becomes the take profit target, and just like that, you watch the trade slide down, smash the take profit, and you've made a whole lot of money. If you are still grasping the concept, let's walk through one final example. The price is currently sitting at a major support area, but we do not jump in blindly. Being at the support level is only one confirmation. We need 3 before we enter, so we wait patiently. Next, the chart prints a massive bullish engulfing candlestick, a big fat green candle right at the support level. This tells us that buyers are swarming the market, pushing the price up, and confirming that the price is unlikely to break this strong support. That is our second confirmation. Finally, we see the moving average cross under the candlesticks. With our 3 confirmations locked in, we enter a buy position. The stop loss goes safely below the support level, and the take profit is set high up at the next key resistance level, a level we identified by looking left and seeing where the price previously struggled. Then we fast forward. We watch patiently as the price climbs, and bam, it smashes our take profit, and we close a great trade. It truly is as simple as that. If this story has helped you, please like the video and smash that subscribe button. And if you are ready to take this strategy to the next level by combining it with deeper candlestick analysis, check out my other videos. Welcome to the tribe, my friends. And always remember, you are just one trade away.